It's part of what was happening with GME, GameStop. Lots of people seem to be querying about margin accounts, what they were, what you can do with them, what the limits were, and various other things. So none of this is financial advice. Don't take it as such. Do your own due diligence. I'm not a financial advisor. This is just for entertainment. So, what's in this video? It's about margin accounts and margin calls. Also touches on some of the things from FINRA and also RH's disclosure agreement for margin accounts. It starts off some frequently asked questions on margins. So 10 questions, the answers to this are in the video obviously, and answers are at the end as well. I'll go through the advantages and disadvantages of a margin account and the requirements and hurdles that you need to overcome to start one off. Third thing is showing you what a margin call is, how it gets triggered. Fourth bit is some examples, showing you the incomings, outgoings, and basically the initial margin and, more importantly, the maintenance margin and how it affects the margin call and what you can do about it. Next bit is FINRA, Financial Industry Regulation Authority. This is some points that FINRA go through with regard to margin accounts. And the last one on this screen is RH. This is the disclosure agreement. This is what you would sign up to if you've got a margin account with them. It goes through the restrictions and it tells you basically what they can and cannot do. And the main thing for a lot of people was shares being sold to what they thought was without their permission. Now this may have happened or it may not. It would depend on the individual account. But if you've got a margin account, then the broker can sell you out if a margin call has happened, and the margin call will happen if the maintenance margin falls below the limit. So that's it in a nutshell. Obviously, the answers to the frequently asked questions are at the end. Full disclosure, I am not a rocket engineer, so if you are going interstellar, please get your rocket checked out by your dealer. That's it. This is about margin accounts, and there's a few little questions that people may have if they're not too sure or they haven't opened a margin account before. So, can shares be used to fund the account or must it be cash? What's the initial margin? Ratio of buying power to equity? Can the initial margin be changed? Obviously by the broker, can it? What's the minimum maintenance margin percentage? And can the broker change that? So there's an initial margin and there's a maintenance margin. What happens if the market value falls below the maintenance margin? Does anything happen? If a margin call happens, can a broker sell shares without asking? Does the broker have access to your shares, or is it only you that can sell them? Does the loan have to be paid back if the market value of what you've bought falls to zero? Can the margin account be used to short shares? Are there any restrictions in the margin account on which shares can be bought? Can day trading be carried out in a standard margin account? So there's 10 questions. Hopefully either you know the answers now, or if you watch the video, you should be able to get 10 out of 10 for this. Well, hopefully. This is a margin account, and I'm only talking about shares. I'm not talking about options here, although you can do them in the margin account. But it's just to keep it straightforward and simple here. In a margin account, the broker is going to loan you some money, and he's going to use any shares you have bought with your money in the loan as collateral. And this is just for normal long trading. Different rules apply for options, slightly different rules and requirements for day trading. Not getting into that at the moment. So you've got a bag of money and you want to go and you want to buy some shares. So to buy shares, you need to have a broker, and you're going to be given basically two options. First one is cash account. That's straightforward. You bung some cash in. You've got to have enough cash in the account to buy. Now you can day trade in a cash account. There's nothing stopping you from day trading because you're trading with your own money. However, you can't short. To short, you need to borrow the share, and basically borrowing the share is sort of like getting a loan of something, so it's equivalent to getting a loan. The other thing is that you'll normally be covered by the normal settlement, which is T+2. So you buy or sell on Monday and they're in your account 2 days later, 2 business days later on the Wednesday. The other option, if you don't want to go for the cash account, is a margin account. And in this one, you borrow money at interest. It's not free, it's not a free loan, from the broker with the intention of buying shares. I'm only covering shares here. You've got to jump over a couple of hurdles. The first hurdle is FINRA, Financial Industry Regulatory Authority. And basically what this says is that to start off, to kick off a margin account, you've got to kick in 2,000 in cash or marginable securities, i.e. securities that your broker will accept as marginable, that he would normally loan you the money to buy. The second hurdle you've got to jump over is the Fed's Regulation T. And this states the initial margin on the account. And the initial margin is set at 50% cash or securities. Now you have got to supply 50%. You've got to put 50% in. The broker puts 50% loan in. The broker can increase that if he wants, depending on your circs. And so basically initial margin is a 50-50 loan in cash. Your equity 50% cash. The broker has loaned you 50% of the money. So if you put 2,000 in, broker will loan you 2,000. So you'll have the equivalent of 4,000 buying power. So the way that it's normally quoted is the buying power divided by your equity, which is 2 to 1. The leverage is 2 to 1. You combine twice as much is what you could have done if you were just using your cash. So the 2 to 1 comes from the loan plus the cash divided by the cash. Straightforward. What's the advantages? The big one is it increases your buying power. You've got a loan, you can buy twice as much. It magnifies any gains because you've got leverage on it. Some people call it gearing. The normal one being used universally tends to be leverage. It gives you access to credit. Now this is credit to buy shares, but the credit line can also be extended to buy non-securities like a car or something like that. It gives you the ability to short. To short, you need to borrow a share. So kind of like the broker, it's equivalency. You're borrowing a share from the broker, you're borrowing money. It's a loan. You've got to pay a fee for it, obviously. You can use your existing assets as collateral. So if you have some shares, you don't need to sell those shares. You could transfer those shares into the margin account, and that would qualify as your equity, and the loan would be the equivalence on top of that if it was a 50-50 initial margin, 50%. The settlement time on the margin accounts can be as low as T+0, i.e. you get the money immediately. And that helps if you were trading a lot. So if you're moving money backwards and forwards and you're getting buys and sells, you want the money back in your account as quickly as possible so that you can use it again. It also gives you the opportunity cost. If you're not using all of your loan ability and you've got some spare, then if an opportunity crops up, you can max out and use the ability to get the loan and use the maximum amount. If there's an advantage side, then there's obviously a disadvantage side. The disadvantages are there's an interest that you've got to pay on the loan. The broker rates vary. If you go on and take a look, you'll find them different rates. Normally, the more that you're borrowing, the lower the rate. That's normal. The broker can change the rates. The broker may nominate some stocks where you've got to have cash on hand. So you would have to have 100% in the account, yours, before you could buy. He's not going to loan you money on some of them. Just as it magnifies the gains, it magnifies any losses because you're using borrowed money. Pattern day trading, whereas if it was a normal account, you can day trade into your heart's content. If you're in a margin account, you'll come under the auspices of pattern day trading rules. And this is limited to 3 round trips in a 5 business day period. A round trip being a buy and a sell, or a short and a cover. If on the pattern day trading you get stamped as being a pattern day trader, bang, you went to 4 or 5 within that 5-day period, then the 2,000 cash that you've got in the account goes up to 25k. You've got a loan. The loan is a liability, and it's got to be paid back, even if the shares go to 0. The tie-up with the shares acting as collateral. Some of the stocks can be designated as limit orders only, and can be a restriction in not having market orders. Difference: limit order is you put a price in, 200. I will not buy the share unless it's 200 or below. Market order is I'll buy the share at the current price. Share price could be 750, could be 500, could be bouncing around. Broker might say no, for this share, for this stock, I'm putting a limit order only on it. You've got to put a price in there. Margin call. This is the biggie. If the account falls below the maintenance margin, and the initial margin from FINRA is 25%, but you'll probably find the brokers is 30%. Some of them can raise that. And they can also change the maintenance margin for specific stocks. So you might have 2 stocks. Stock A might have a maintenance margin, a house margin of, say, 30%. Another stock B, the broker may have imposed a higher maintenance margin, say 40% on it. So that'll affect the margin calls. You'll get a margin call earlier on a higher 40% maintenance margin than you would obviously on a 30. The broker can raise these limits as well. If you get a margin call, he requires extra funds or qualifying marginable assets that you can bung into the account. The broker can sell anything in the account in any order that the broker thinks is the best way for the broker to get the loan back, to cover the loan. You can't say, oh, if I hit the margin call, can you sell stock B first rather than stock A? The broker goes in, they do the little risk, which one's going to give us the best ability to pay the loan off. And the last one, the broker may designate some of the stocks not marginable. So you couldn't buy the stock on margin. not in that account. So there's the advantages, there's the disadvantages. That's kind of like a quick overview of the margin account. Talking about the maintenance margin on shares. So the basis for this example is the original market value is 10,000. That's 5,000 from you and 5,000 from your broker. It's based on a maintenance margin of 40%. And there's a question in there that says what market value is going to trigger a margin call. That's kind of like what you're going to be wondering. So here's the initial. You've got 5,000 from yourself, 5,000 from the loan. The breakdown, obviously, it's 50% each. The maintenance margin is 40% of the total. That's 40% of the 10,000. So your equity is in excess. It's 50%, beats 40. The margin security is obviously the shares that you've bought on margin. That's the collateral. The market value is 10,000. And the loan to value is 50%. The loan is 5,000. The total value, market value is 10,000. So your loan to value is 50%. This is assuming that the share prices went down and the market value is now standard 9,000. And the loan remains the same, it's 5,000. But the percentage that the loan is now 55. That's 5,000 over 9,000. The equity, your equity in this is 4,000. So the percentage has went down to 45%. But there's no problem with that. The maintenance margin is 40, and your 45 beats 40. So there's no margin call at this point. Now, as the market value falls, the broker's collateral cover gets reduced until you're going to bump into the margin call. It's obviously it's triggered when you get to a loan to value of 60%. It's just, the reverse of the maintenance margin. It's just 1 minus 40%, 60%. The margin call is triggered when the market value equals the loan divided by 1 minus the maintenance margin. So the market value is 5,000 divided by 1 minus the 40%. It's the 60%. That gives you 8,333. So if the value falls below 8,333, then again, this will happen. Market values went down again. It's went to 8,000. Your loan to value is 62%. The equity is down to 3,000 because it's 8,000 minus your 5,000. Your equity is 38%, which is less than your maintenance margin of 40%. At the top there it says it'll be reduced until a margin call is triggered at an LTV of 60. As you can see, the LTV went up as the loan is going down. So it's went from 50 to 55. It's passed through 60 to get to 62. Passed through 60 at 8,333. So there's the line that the equity would need to be at to maintain the ratio that you need to have. So basically you're having to put money into it to compensate for the lack of market value due to the share going down in price. Things that can affect the share prices and stuff like that, this is not directly relatable to it, but it's like a material adverse condition. It's the ability to repay is compromised. And this is sort of like what your margin call is, whereby your ability to repay the loan has been compromised by the share price going down. So the broker will issue you with a margin call, email, text, something on the website that basically tells you, get off your backside and do something about this. So the margin call is numbers there is 38 less than 40, obvious. 8,000 by 40% is 3,200 minus the 3,000 that you've already got is your residual equity of the market value. So you need to pay 200 in. So that's 40% of the 8,000. So you're saying, well, that's in essence paying back part of the loan. And it is, because basically the percentage of your equity in this stock has got to be 40%. If that's what the maintenance margin is. If it's 30%, then obviously it's less. So if the broker is offering you maintenance margin of 30, and another broker is offering you one of 40, you're not going to get a margin call until later on the one with 30%. This is just to wrap it up. As the market value changes, the equity percentage changes. Now all the examples tend to give you two, where the equity's going up, yeah, isn't it great? You're making money, so your equity percentage goes up. That's what's giving you the leverage. That's what's making it attractive. And the loan to value changes. So that's basically the mechanics and the numbers associated with having a margin call. Okay, this is about margin calls, and it's only for shares. There's different rules for options. Basically, a margin call is when the equity in your account is below the maintenance margin. The normal starting maintenance margin is 25%. The broker can increase that. If you get a margin call, you need to either add some money or sell some shares. Before you can start a margin account off, you've got to have, from FINRA's mandate, you've got to have $2,000 in the account. If you're a day trader, that goes up to 25,000. You need to take a look at the exact rules for day trading, how many you've got to trade over 4 or 5 days, blah, blah, blah. The other thing which is covers margin accounts is the Fed Regulation T. This covers the initial margin. That's what you're starting off with. And it's got to be a minimum of 50% cash. The broker doesn't need to stick with that. He can raise that cash amount. He can raise that minimum above 50. So if you put 5,000 into the account and you then took a loan out with the broker for 5,000, you would have 10,000 in the account. You'd have to pay interest on the loan section of that. You'd have to pay interest from when you've taken it out to when you close the loan. I've put an interest in there, 2.5%. It could be anything which the broker decides that they want to apply. And obviously that will be in your margin agreement. Break even for you, because obviously it's 50-50. If you bought some shares with this and the shares went up in value, market value is 12,500, then you've got 12,500 in your account. All of the shares you own. The broker doesn't own the shares ever. It's you that owns them. But on that 12,500, you've got 5,000 of an outstanding loan. You can see that the loan percentages went from 50 down to 40. In your equity, once you've taken the loan out, has went up from 50 to 60. So the shares went up 25%, but your account has went up. The blue bit has went up by 50%. So you factored that up by a factor of 2. The shares only went up 25, but you gained 50%. You went from 5,000 to 7,500, whereas the accounts only went from 10 to 12.5. That's one of the main reasons, apart from if you don't have enough money to use a margin account. If you trade with it, then you can X up your buying power. You can also X down if the share falls below what you've bought it for. So it magnifies your gain and it magnifies any losses. The customer equity is the market value minus the loan. The market value is normally done at close. That's normally 4 o'clock, 1600 hours Eastern time. But the broker can go to real time if the shares are moving around and it's extremely volatile. This is the margin security, which is the market value of your shares. Now, this is if the shares have went down. You initially bought them for 10. Now the market value is only 6. That's assuming that you didn't put any sort of stop loss in to stop yourself getting into that position, or whether you decided that you, even if it did go down, you want to ride it out and pay the margin. The problem with that is that if the broker instigates a margin call and you're not swiftly enough, then you could find that the broker has sold the shares to cover the the margin call. The loan hasn't changed, it's still 5,000. Difference is it's now based on the market value. The loan is 83% of the market value. And the customer equity, your share of it, has went down to 1,000. 1,000 is a percentage of 6,000 is 17%. That's less than the maintenance margin. It'll trigger a margin call. What you'd have to pay would be the market value times the maintenance margin percentage. minus the market value minus the loan, i.e. your equity. So it's the market value times the maintenance margin percentage less your equity. So this is just a recap there. Maintenance margin percentage decided per stock. It's not per year account. So some of the shares could have a maintenance margin 25. Some of them could have a different higher percentage. It's based on the factors, big ones obviously, volatility and liquidity. Can be changed by the broker. Like I say, the market value is normally based on market close, but broker can revert or go to real time. It depends on your margin agreement. You need to read through that. So this is the calculation, just a little bit more detail. The maintenance margin's 25%, so 6,000 at 25%, quarter, it's 1,500. The equity, the customer equity, which is the market value, 6,000, less the outstanding loan. The loan hasn't changed, haven't paid anything off, it's 5,000. So the customer equity, that's the blue bit, is 1,000. So you need to bring the 1,000 up to the yellow line where the 25% is. You need to add 500. So pay 500 into the account or sell some shares to cover this. So obviously, if you were quick enough and you decided that you wanted to sell the shares, you could do this. If you were not quick enough and the broker put in a margin call and decided to go with it straight away rather than giving you enough time, like a day or whatever, to pay the money in, then you could find that if you had an account with a number of shares in, that the broker sold a share that you didn't want to be sold. That's as long as it's in the margin account. You've got no control over which shares the broker would sell. I'll show you an example where the maintenance margin is changed. Now this time, the maintenance margin, let's call it volatility, is going to be changed from 25% minimum, and the broker is going to crank it up to his house requirement, which is 75%. Now it could be anything, it's up to the broker to decide. So this was the example on the last sheet there. 5,000 loan, 25%, pay 500. This is if the maintenance margin was increased to 75%. You can see it's dramatically different. The market value hasn't changed. Shares are still worth 6,000. Customer equity, that's the blue bit at the bottom, hasn't changed. It's still 1,000. That's the market value less the loan. So pay 3,500. You get that same calculation. It's the maintenance margin times 6,000 gives you 4,500 less the customer's equity, which is 1,000, gives you 3,500. Calculation at the bottom there. 1,000 plus 3,500 gives you 4,500, which is equal to 6,000 times 75%, 0.75. So pay 3,500 into the account or sell some shares to cover this. The main thing is you need to understand the margin agreement that you signed up for. These are just the calculations for the last two, and just showing you where they came from. So that's it, margin calls. That's just for shares. Options are different, the different percentages and different holdings and blah, blah, blah. But these are just for if you're basically going long with shares. That's it. So FINRA, the information which I've got is from FINRA. It's a government authorised not-for-profit organisation that oversees US broker dealers. Basically, it goes through what brokers can and cannot do. And the bit which I'm going to show you is their section on margin accounts. So this is FINRA's. What I've done is I've pulled it off the website so I can highlight some of the parts of it. Investing with borrowed funds. It says no margin for error. These bits in red are some of the things which people should realise that the margin account involves. Lots of people apparently either did not understand the full extent of what the margin account involved, or they just ticked the box and said they'd read it and just skipped past it. The main ones are the broker firm can force the sale of securities to meet a margin call. The firm can sell securities without contacting you. You're not entitled to choose which securities or other assets in your accounts are sold. So if there's a margin call, the broker can go in and it can take the most advantageous for it and sell them. It doesn't have to consult you, and you have no say in the matter. The margin requirement can be changed at any time, and the broker doesn't need to tell you in advance. As long as the margin requirement is the minimum which FINRA requirements state, then they can raise the margin requirements. There's no extension for time on the margin call. Once the broker has made it, that's it. And you can lose more money than you deposit on a margin account. So buying on margin accounts, it's getting a loan from your firm. When you buy on margin, you must pay both the amount you borrowed and the interest. And the interest is accrued on most accounts on a daily basis, and it's compounded. Even if you lose money on your investments, you're still liable for the loan. The loan doesn't go away. It's not dependent on how the shares do. The loan is with your broker. Buying on margin carries a cost. Costs the interest you pay. Margin interest rates generally vary based on the current broker call rate or call money rate and the amount you borrow. The rates obviously can vary from firm to firm. Tells you where you can find the latest stuff, either in the journal or on the websites. It says before purchasing a security on margin, requires you deposit 2,000 or 100% of the purchase price, whichever is less. This is called minimum margin. There's different rules if you're day trading, and there's different requirements. If you're day trading, you're required to deposit 25k in there. The firm has the right to sell its own margin requirements, often called house requirements, the right to set, as long as they're higher than the margin requirements under the regs. Some firms raise the maintenance margin requirement for certain volatile stocks. So if the stock's floating around like what GME was, then the broker can say that the margin requirement that they require to hold on that is higher than normal. You've got no say in it. It goes through the risks. Firm can force the sale of securities in your account to meet a margin call. The firm can sell securities without contacting you, and you're not entitled to choose. These give you a little bit more substance on it. The firm can change requirements at any time, and it's not required to tell you in advance. You can lose more money than you deposit. So like a decline in the value of the securities you purchased on margin may require you to provide additional money to avoid a forced sale on them. And this goes into short sale positions. Take a look at this. If you see that the securities in your account are falling, declining in value, you may want to consider adding additional cash securities to attempt to avoid a margin call. So basically it's saying the onus, the responsibility is on the account holder. It's not on the broker. The broker is looking after its loan. That's its prime concern. Its prime concern is the money which it's loaned for you and how it's going to get it back. The shares you've got are collateral, but the collateral, the shares are going up and down in price all the time. This is affecting the margin, so it's affecting the margin call. Now, normally, if the shares are perambulating at a very slow pace, then you can see the margin call coming, possibly very, very slowly, and do something about it. But if like GME, it's going 100% up in one day and then coming back 60, 70, 80, 90, 100%, you can see if you bought while it's been near one of the highs, and the price falls 50, 60, 70%, and you've bought it on margin, you can see how the margin call would kick in straight away. Saying if you get a margin call, act promptly. Doesn't make any difference. Even if you act super promptly, the broker could have still sold your shares in advance if you put the money in. Broker is not required to wait or give you any notice period. There's a load of other stuff in here with links, but this is on the FINRA site. This is the Robinhood financial margin disclosure statement. And if you go through, and obviously a lot of people that were on WSB were using RH, so a lot of them, if they were on margin, would have signed up for this agreement. Whether the people read it is one thing, whether the people that read it understood it is another. But the onus is on the person that's reading it, that's got the account, to understand the implications of it. This is similar to the FINRA, but it's obviously specific to RH. It's just saying if you buy securities, you can pay for them in full, or you may borrow money from your broker. And in this case, it's obviously from RH. The securities you purchase are used as collateral. So it's like if you were buying a house, the house is collateral against the mortgage which you've got. Same thing happened in the financial scam 2008-9, where the value of the properties fell. It's the same sort of thing. Securities purchased are used as collateral. If the securities fall in value, obviously your collateral falls in value, and they can take action. And the action which they can take is issuing a margin call and or sell securities or other assets in any of the accounts which you have with them. So they can suck money out of any of the accounts. They can sell any of the securities that you have before you've had time to up your account with money on a margin call. It's entirely at your risk. It's basically saying you can lose more funds than you deposit on the margin account. Decline in the value purchased on margin may require you to provide additional funds. So even though you bought them, if the value of the security goes down, you're still due to pay the loan. Basically just reinforcing it. We can force the liquidation or sale of securities or other assets. There was a lot of talk on WSB, a lot of people saying that had been sold out. I didn't ask for this, blah, blah, blah. It may be that they had margin accounts, I don't know. You would need to go through in detail on the boards and see. What it sounds like is that that's what has happened, i.e. there's a margin call. RH has applied the margin call and just said, right, we've got no idea where these where the market's going with these. You're deep in debt on your margin. To protect ourselves, we are selling what assets you currently have, and you still owe the balance. That may or may not be it. Individual cases, you would have to go into the actual people, would have to tell you whether they are actual normal accounts or margin accounts. They can sell the securities or other assets in any of your accounts, any of the accounts. So you may have a margin account, you have a non-margin account. If you've got them with the same broker, they're saying they can take money out of your non-margin account to cover it. You're also responsible for any shortfall. So even if the share goes to zero, if GME went to zero and you had bought it at say 250, and you'd bought it on margin, on a 50-50 margin with RH, you're in the hole for 125 to RH, because that's the loan that you used to buy. And this is reinforcing it again. They can sell your securities or assets without contacting you. They've got here, and obviously this seems to have happened, some investors, gamblers, people, account holders, whatever you want to call it, mistakenly believe that their brokerage firm must contact them, i.e., you've got to be given the option, their phone, email, text, whatever. And then you've got like a ticking clock. You've got like 24 hours or so to put it back in. No, that's fantasy land. For a margin call to be valid, and that their firm cannot liquidate securities or other assets in their accounts to meet the call unless the firm has contacted them first. This should be in really, really big bold. This is not the case. You've signed up for this account. These are the terms that you've signed up for. Just because you're not aware of them doesn't mean to say that what's happening is not valid. Ignorance, bliss, and stuff. Although we may attempt to notify you of a margin call, obviously if things are perambulating slowly, then obviously they'll give you a chance. But you've got to remember what was happening with GME. It was just like shooting around all over the place. They're not required to do so. And obviously you've got to take into account the volume of dealing and the amount that the shares were being traded to. There's a difference if it's like a couple of thousand shares and the share price is like 2. It's a difference if it's 500,000 shares, the share price is 400. It's a huge amount that's on loan to the broker. If the broker thinks that GME is going to earth, going to zero, they don't want to be hanging around with these loans and having to try and get the loan back. We can still take necessary steps to protect your financial interests, including immediately selling the securities without notice to you, i.e., we think you're going to crash and burn and our loan is going to get destroyed. So, to prevent that, we're going to sell it. We may forcibly liquidate all or part of your account without prior notice. You've signed up for the Foreign Legion and they've got you by the goalies. Different complaint. You're not entitled to choose which securities or other assets, like basically you can't say, well, sell A but keep B. You know, sell me Telsa but keep me GME. You cannot do that. The broker will sell whichever ones they think and deem fit. They're telling here, we can increase the house maintenance margin. They can change the percentage that you have to cover on your loan at any time. And they don't have to tell you in advance. Not entitled to an extension. This one that most people, it came about because of the shorten, and people now understand to a greater degree what shorten means in the borrowing of shares. But there's also the hypothecate of assets, securities. Basically what this means is that RH, in this case we'll consider it's RH, RH considers the shares that you've bought on margin is the collateral. That collateral is considered as an asset. RH can then loan those shares out to someone else and get paid a fee for it. What also the RH can do is they can use the loan as their collateral on a loan. That's what hypothecate means. They can use your loan as is their collateral on a loan. It doesn't really affect people. And also you've got to bear in mind that RH is providing you with a no-fee broker. RH has got to make a profit somewhere. If RH loans out shares, gets a fee in, that's enabling them to make profit on share dealing, I would imagine. If RH has borrowed money, they can use your loan as their collateral to back up their loan. So it's like a stacked loan. You can read that maybe pledged, repledged, or hypothecated, i.e. these loans can be loaned out and used as collateral, blah, 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 blah. Some firms now restrict the loan to be hypothecated out. The rules are slightly different in the US to what they are in the UK. The hypothecation rules are laxer in the UK. Any securities in your margin or short account may be borrowed by RHS or lent to others. Normally, it doesn't affect you. Normally, nobody takes the slightest bit in notice of it. It's talking about voting rights, which most people don't give a tommy about. And then it tells you that they charge interest on a daily basis on the credit that they extend at the margin interest rate. It tells you how they calculate it. They base it on the margin rate, margin interest rate, divided by 360 rather than 365. It's not unusual. It just means you're paying a tiny little bit more than what you would normally do, because it's based on a 360-day rather than a 365. It's nothing. It's absolutely zero over the year, unless you've got an absolutely huge account, of course. It's telling you that they can change the MIR, the margin interest rate, anytime they want. What it's saying is the minimum initial margin requirement is 50%. That's from FINRA. That's agreed across all of the brokers. It doesn't mean to say your broker can't change that percentage. The other thing in this bit in red, different requirements apply to non-equity securities, such as options. So if you're buying, purchasing the share, but if you're using an option, which is obviously a derivative, then obviously different requirements apply. Initial margin requirements may change. They can impose more stringent requirements. It's at the broker's discretion. You've got no say in it. If some of them involve higher levels of risk, and obviously GME, when it was happening, is a classic case for it. What it's also saying is the limit what you may purchase on margin to be used as collateral. More likely, all of the penny shares in high-risk shares would be taken off the board. You could still buy them in an account where you had the cash, but you couldn't buy them on margin, couldn't buy them with your margin, because the broker deems them it's just too risky. It's too risky. They are looking after their loan. That's what the broker is concerned about. Can they get the money back against the collateral? If that collateral is just going to earth, broker's going to sell you out. He wants to keep his money. Of course he does. It's just going on, maintain minimum amounts of equity, collateralizing the outstanding margin, blah, blah, blah. It's subject to a first and prior lien, i.e. it's top of the pops. The broker gets first shout on it, for it. So you must pay him off. Your loan is number one. This bit, you should carefully review this margin disclosure statement. There's a lot of people saying, FRH, I'm going to change accounts and stuff like that. And that's up to them. But if they go to another broker, they need to read the margin agreements on them. And they'll probably find that the margin agreements at the other brokers are along the same lines as RH. So it's like the frying pan and the fire. Effort, I'm moving, RH have screwed me. Possibly they have, I don't know. Possibly they haven't. Need to go through, look, check it out. If that's happened, your margin requirements have been, had like a margin call and they've sold you out. That's it. It's really, really simple. So that was FINRA and that was Robinhood, and that's their text on margins. So this is the answers to what you've all been waiting for. It's the recap on the margin account. And there's a little hint in there. Hopefully you don't need the hint. So the first one, can shares be used to fund the account, or must it be cash? Well, the answer is yes. The broker will take any marginable shares that the broker deems marginable. Some shares, perhaps some penny shares, kind of won't be. But the broker wants to get the account going. He wants to give you the best option. If the broker could trade your granny and your granny was marginable, he would take your granny. The broker wants to get you started. He wants to make money. What's the initial margin ratio of buying power to equity? It's 2 to 1. You put up half and the broker puts up half. 50% your money, 50% the broker's. It's normally called leverage at 2 to 1, i.e. you can buy twice as much as what you put in. The 2 is the total amount. The 1 is what you have thrown in. 2 to 1. Can the initial margin be changed? Yeah, broker can change the margins and stuff like that. They have to abide by the FINRA and the SEC rules for the minimums, but the broker can change the margins, yeah. What's the minimum maintenance margin? That's after you've started the account off. What's the minimum margin, maintenance margin? And can the broker change it? The minimum maintenance margin is 25%. And yes, the broker can change it upwards. A lot of them brokers 30, some of them 40 for individual shares, it can be changed. What happens if the market value falls below the maintenance margin? I'm just considering one share here. We bought a share, falls below, let's just use this example of 25%, falls below the 25%, that's your equity. What you've put in is a percentage of the equity and the loan. What happens if that happens? You get a margin call. You can keep it. Yeah. Oh, I've got a margin call. There you go. The options, as you should realise, is put more money into the account, sell some shares, or get your granny as a marginable security and bung that in. So you can bring something that you haven't already got in the account in, as long as it's marginable, into the account. The normal one is put more money in. Depends on the share. If it's a slow moving share and you've just squeaked in and you've got a tiny margin call, it's unlikely that the broker will sell your shares. If on the other hand, it's like 95% of your account and you're in the hole big time, then yeah, the broker has the option to sell your share. Broker's going to try and give you as much chance as reasonably possible to pay for it. But at the end, the broker is looking after their loan. If a margin call happens, can the broker sell shares without asking? It's a simple one, not. Yeah, of course they can. If margin call happens, can the broker sell the shares without asking? Yes. Broker can sell them. Broker's prime concern is to keep enough cover collateral in your account to pay off the loan. The brokers also want to keep you on board as a client. So does the loan have to be paid back if the market value falls to zero? Yeah. The loan is completely divorced from the share price in that respect. It's tied to it. With the maintenance margin percentage, but the loan is separate. Doesn't make any difference if the share price goes to the moon or falls to the ground. You are still liable to pay the full loan plus any interest on it back. Can the margin account be used to short the shares? Yes. It's quite straightforward. You borrow them from your broker. Broker charges you. If the broker has access to it, he'll just charge you the interest. If the broker doesn't have access, if it's not a commonly traded stock or the broker doesn't have access to it, then you would have to pay a fee on top for the broker to go out and access those shares for you. So answer that one is another yes. Are there any restrictions on which shares can be bought? Yep. The broker will only allow you the margin on specific shares. It's easier to go the other way. Most of the shares are marginable There'll only be specific ones that are not. But penny shares, penny stocks, possibly not. Different brokers, different things, but yeah, there are restrictions. Yes. Last one. So we can get 10 out of 10 here. Can day trading be carried out in a standard margin account? Yes. Yes, day trading can be carried out in a standard margin account within the confines of the PTT, pattern day trading rules, which is 3 day trades by sell, or a short and cover 3 round trips within 5 consecutive days. So if you did 3 buy and sells on the Monday, that's you effectively blocked from doing anything until the next Monday. If you had to do it on the Wednesday, you would have been blocked. You can do that, but as soon as you do that, and you get classified as a pattern day trader, then the limits change. You've got to kick in the account of 25k. But normally, yeah, buying power will go up. And you normally get a margin of 4 to 1. So yes, you can do day trading as long as it's 3 within 5 consecutive days. So there you go. Everybody should have got 10 out of 10. Hopefully, how are you? Oh, we've got some extra bonus thingies. Can you trade options, spreads, futures, and all that good stuff? Yep. But different margins, rates apply. It's too complicated to put it all in. You need to go on to a specific broker. You need to take a look. You need to see what the actual price structures are, fee structures. Pattern day trader, max 3 buy, sell, or short cover in any 5 business days. We just covered that. You're classified as a pattern day trader. We've just covered that. Initial margin reduced from 50% standard margin to 25% day trade margin. So yeah, if you had to kick in your 25k, then your buying power is 100k because your leverage is increased to 4 to 1. If it goes overnight in your day trading, the leverage goes down to 2 to 1. And there can be more fees as well for shares which you keep overnight if you're shorting. Portfolio margin. This is a specific type of a margin account, but normally it's based on all of the assets which you have in your account on some sort of risk-based basis, whether they bung them all in, they chop them up into different elements, and normally that would be that you would have a lower margins on it. It's normally just for people with higher amounts, 100k or more. Normally you'd have to prove that you've traded on margin for a number of years, 3 years or so. And normally you would have to pass a competency test where you get asked certain mortgage questions. And that's two things. That's to protect them, and that's really to protect you. If you don't know what you're doing, then you can get yourself into mega trouble, because it's bigger amounts of money expectation. Some of the interest payments may be tax deductible, but I'm not a tax advisor. This is not financial advice. Do your own due diligence, do your own tax advice. Refer to a tax advisor for that. Can you use the equity in your account to obtain other non-stock related loans? So that's using your equity in any shares that you've got on margin. So basically this would be like an extension of your loan, but not to buy stocks. So you wanted a new Lambo, go to your broker, because you've got your margin account. He ups the money for you and off you go. So basically you're using your assets within the account to buy something out with the account.